What's up, guys?
It's Rowan
and Terry
here from Art Smart TV, bringing you another episode of
the HSC Economics Review.
Now, in this episode, we're going to be diving into the big question of why does Australia have a current account surplus? Historically, if we zoom out for a moment, Australia has had consistent and persistent current account deficits over the last 50 years as a percent of GDP. Now, as a result, the recent current account surpluses we've had in 2019, a surplus of 0.6% of GDP, and in 2020, a 2.5% surplus, therefore are highly unusual historical anomalies. What makes this even more remarkable is the fact that during Mining Boom 2, when Australia had what was considered at the time a once-in-a-lifetime peak in export volumes, our current account remained at a deficit around negative 3% of GDP. So I think the key question as we look to unpack this question of a current account surplus is, how on earth have we managed, therefore, with the COVID sort of pandemic and COVID recession at play as well, to somehow find ourselves in this position where we have a current account surplus? Now, in this episode, Terry and I are going to dive in and look at a couple of things to unpack this. We're going to look at the trends in Australia's trade, some of the key influences and drivers of that trade, and therefore how these have played a unique role in contributing to our current account surplus. And then we're going to explore some of the implications of a current account surplus and what that might mean for Australia moving forward. So, Terry, let's dive right in. What is, at the moment, the overall sort of surface level reason for why we have a current account surplus?
It's a great way to start, Ron. I think the best way to look at it is, first of all, just revise, our understanding of the components of the current account. And so when you look into the current account, there's three accounts, but really we only focus on two of them. So if you've forgotten, the current account is made up of the BOGS, the balance of goods and services, and then the net NPY, the net primary income. And so when you look at a current account surplus, logically speaking, there can only be a surplus if either one of these accounts is in a huge surplus or both of them are in a surplus. There has to be one of them. And so on a surface level, as Rowan said, it is clearly the BOGS doing a lot of heavy lifting, but even the NPY, I feel like, has kind of done its bit to be in a smaller deficit position to lift us into the current account surpluses that we're currently seeing.
Mm-hmm. And so if we just contextualize that, I think some of the key things to look at, and if you look at the data across really the last 20 years even, what you can see is that, Australia's income balance, so the net income balance, generally, particularly since GFC at least, has sat around about negative 3% of GDP. So it stayed fairly consistent. There were a couple of years where it sort of dropped below that around 2006-07. But, zooming out from basically the early 90s to now, negative 3% of GDP is pretty consistent. Now, what's interesting, though, is certainly what has happened, particularly with the trade balance. The trade balance is highly cyclical. It varies quite a lot. And we certainly can see that fluctuation. But what's interesting is that our trade balance has shifted from really, a pretty standard somewhere around negative 1 to negative 2% of GDP to more recently a positive 3.5% of GDP. So it's had quite a significant turnaround, which is in a large surplus, which then offsets any deficit we might have on our net income balance. So I guess let's start at least with a conversation then about what has caused the trade balance to shift so much. You're right, there have been some changes to net income, but I think they're probably a little more marginal than what we've seen.
I just say that because it's so heavily usually entrenched in such a deficit position that I'm just happy, just to see it doing a little bit better, because it's usually in that, 5-6% negative
That's right.
percent of GDP range. Now it's getting up to 3 or 4, good on you.
Yeah. That's it. Awesome. So what are some of the trends that have been going on with trade balance to kick things off?
So with when we're talking about trade, I think you need to think about trade volumes and trade prices. Yeah? And in your course, you do look, at trade volumes, which is quite straightforward, which when you just look at the volume of exports and imports going in. But we need to also remember that the prices of these particular exports do matter as well, quite significantly, right? Because, imagine a world where we don't care about prices. And so a key thing I would be looking at is, well, first of all, what are the prices of the things that Australia typically does export? Right? And then overall, is there some kind of measure that we can use? And it turns out that we do have those, right? We have the terms of trade, which, if you remember, is an index of the export prices over the import prices. And a increase in the TOT, for example, means that we are therefore selling more valuable exports. We're getting more money for them.
Relative to our imports, particularly.
Yeah.
Right? Okay. I just want to throw that in.
Okay. Right. And so currently we've had a massive increase in our terms of trade. And then going back also just to our exports as well. I know you hear it a lot, and I'm going to say it again, but our mining exports in particular have done fantastically, even despite all these tensions, with China or with other countries. Our mining exports have just gone through the roof.
That's right. And so let's, if I could sort of, I guess, make a point that maybe steps back a little bit before we look at price and volume, right? Is to also look at, well, what's the composition in some respects? Because I think our price and our volume has been also positively impacted by a change in our composition. And I think what's interesting is, Australia is certainly seen, and you look at this in the trends in the course, we used to be back in the 70s, agriculture represented almost 60% plus of our export base. And since then, we've almost seen a changing of the guard where our resources, particularly in mining boom, mining boom 1 and then, into mining boom 2, really peaked at almost just short of 60% of our total exports. So this goes to the point of like a narrow export base. We certainly have one. Now it dropped post, mining boom 2 as we went into secular stagnation. But what we've seen happen really since about late 2016, start of 2017, is we've seen the share of our total percent of exports increase again from a resources point of view, and it's back at mining boom 2 levels, pretty much. Now, if we think about that, and we think about, well, we're exporting as a percentage of our total exports more resources, then any changes in price certainly have some interesting implications.
They're just going to get amplified.
That's right, precisely. Now, there have been some changes in price. I'd say before we get there, though, I think they've been largely influenced by things out of Australia's control. Like, I think we've been really riding some global headwinds.
Yeah.
Some good, some bad. What's been happening globally that's then influenced price for resources?
Okay, so when we talk about prices for resources, it's not something we explicitly look at in this course, but it's just like any other market. Your price is determined by your supply and your demand. And so what we might have expected last year, first of all, is a decrease in demand due to COVID restrictions and lockdowns and lack of spending and from various countries. But on the supply side, there's been a huge issue in Brazil. I think it's been going on. I think it's been going on for a few years, and it's actually continued. And that's they're traditionally quite a large, I believe, iron ore producer. And then obviously, since their dams there's been a dam collapse and they haven't been able to get in there and mine, there's been a massive undersupply of iron ore, which then gives us a brilliant opportunity to step in and not only provide that, but then also get some really, really good prices.
Yeah. So just as a little bit of context, Terry's right. I mean, this is definitely sort of beyond the course, but I think it helps contextualize and create a better understanding. There are things called tailing dams. I'm going to do a horrible job of explaining them as well, but basically...
Better job than me, honestly.
You have a lot of byproducts, I guess externalities, right? If we link it back to the environmental part of the course for a moment, when you do mining, there's a lot of externalities, and one of those is just all the sludge that comes off the back of what you're doing. That needs to get dammed so it doesn't seep into the rest of the environment. The dams that have been constructed, they're called tailings dams in Brazil, have not been particularly sound. There's been some major collapses that have then, and really bad stories of hundreds of people dying, huge environmental destruction. So not good outcomes. Of course, what that has meant is at a base level, yes, less supply, but it's also resulted in, for Brazil, one of the big companies there is called Vale. I'm probably mispronouncing it, but let's just go with it. They've had to close in 2020 alone. In Brazil, 47 iron ore tailings dams, which then impact their ability to actually mine because they can't store all the sludge off the back of it. And so there's just had a significant impact on supply. which I think COVID then has exacerbated because Brazil has also not had a particularly good track record in handling COVID, which definitely has impacted the supply.
Which means even if they cleared this issue up, they probably wouldn't have been able to go to work.
That's right. And so there still would have been some supply constraints. On the flip side, Terry, what's been happening with demand?
Demand is just powered through. And I guess you talk obviously about on the backs of China and their strong demand for iron ore, but in particular to fund their infrastructure and projects. If you remember, we might have talked about this in previous videos. The One Belt One Road project, I believe that's still going ahead, which is going to require a lot of these particular resources. So demand is just maintained the same. So you look at demand still up here, supply has gone all the way down. Perfect storm just to create some very, very high prices. To illustrate that for you, obviously when COVID hit, things did take a bit of a tumble because people were just unsure. We've talked about investor confidence and market confidence in the past. So during COVID, we had $61.57 dollars per ton for iron ore, and that got up to a high of $173 per ton, which is close to what it was during the mining boom.
Yeah, it was. Yeah, it pretty similar levels to mining boom too, which is crazy, right? Because we're at this point where we've got prices being at levels close to sort of mining boom too, which is awesome. And we've also got, as a result, therefore, the composition of our export base being also pretty similar to mining boom too.
It's just like they just picked us.
Yeah,
they picked our number.
We got lucky, right? Now, I think that's an important thing to highlight. Like, Australia has really, in many cases here, really struck luck twice in a row. Like mining boom, we were lucky. We happened to have resources, and China was nearby and going through massive growth. We were the logical. And we now sort of got a little lucky again at the expense, unfortunately, of Brazil.
It's not luck if it happens twice.
Don't tell the politicians that.
Now, I think they already know.
Yeah, that's true.
They believe it.
What does this all mean then for terms of trade? Because that's where you started, right?
Yeah.
And I think it's a nice sort of like bookend, right, before we then look at some international competitiveness stuff.
Yeah.
What's been the impact?
So if you remember that with the terms of trade, it's an index of prices. So it is going to be, there's, long story short, a lot of mathematical calculations that go into it, but basically the more of a certain product that you export or import, the more that particular product's prices are going to influence your terms of trade. So obviously with resources being 60% of our export base, as Rowan touched on earlier with the composition, obviously these particular commodities are going to be a huge component of that terms of trade. And as we just said, the price has gone up, so you guys follow along, the prices of the commodities go up. Therefore, our terms of trade goes up because of just how such a dramatic section of our export base these resources are.
So just to put that in context, right, 2017 we sort of saw, or 2016 really, we saw our terms of trade drop to sort of just over 70 as an index, okay? What's been really interesting is that, come 2020, it's now cracked, just over the 100 mark. And that, again, is similar levels to what we saw in 2011, 2012, right? Again, sort of peak mining boom, essentially. Which should be no surprises, given that iron ore prices are at similar levels.
They tripled.
Yeah.
Yeah, so and when you think about it, like 70 to 100 doesn't sound like a lot, but you've got to think of it as a percentage, right? To go up 30 points, that's nearly half.
That's right.
So it's been a really, really dramatic kind of turnaround.
And I think the thing to note is that if you zoom out and look historically again at a much bigger, longer term picture, generally speaking, outside of the mining boom, our terms of trade was lucky to reach highs of 70. Like it would really sit between 50 and 70, and closer to 50 more often than not. So mining boom, itself was already like this anomaly historically, and to have it again so soon, it certainly is, I think, a great benefit for Australia, but certainly unusual. Now, Terry, what's interesting though is we've just unpacked very similar conditions there. Well, the driving reason for the price is a little different. Mining boom, it was just excessive Chinese demand.
Yeah, so I think we can just contrast it as demand versus supply issues.
That's right, yeah. But the pricing, the terms of trade, the percentage of volume of exports, all of that's pretty similar. And yet the difference is, our current account maybe got to a low of negative 3% of GDP during mining boom 2. And we're now at a 2.5% surplus. What's the key differentiator this time around that's just changing the game for our current account?
So I just want to, think back to, the sweet days of 2011 when you could go online shopping and you could buy whatever the hell you wanted because the Australian dollar had actually gone over parity with the US dollar. So a key thing to remember in the mining boom last time was that the Australian dollar was just through the roof, right? It was so high. And it was driven, of course, through this excessive demand for Australian exports in commodities. It appreciated like crazy. But then the issue with that is that, as you guys know, when you have such a high Australian dollar, industries that aren't as attractive to the foreigners will suffer a lack of international competitiveness just because it's so expensive now to buy those particular Australian products. So they'll look elsewhere, and these industries will tend to suffer a loss of export revenue. Mm-hmm. But this time around,
it hasn't happened, right? So just what that's called as a quick is Dutch disease, which is what we saw happen. It's based on the fact that it first happened, or at least it was first recognised happening in the Netherlands in sort of like the 80s with their manufacturing sector. In short, what happened in mining boom 2 was as the dollar went up, we were sort of like just, making bank off our resources, right? Yeah. But on the flip side...
And consumers were happy.
We got to buy lots of cheap goods, as Terry said. But on the flip side, our service industry particularly got really hit. So education, financial services, tourism, all of a sudden, if you're a foreigner thinking about coming to Australia, it's no longer cheap.
No, don't do it.
And our services tend to be quite price elastic, where commodities, because they're driven by economic growth, tend to be a little more price inelastic. And so we saw that even though we were making incredible dollars off the back of our resources, other industries were actually struggling. And so that meant that our total export revenue was never going to be as good as it possibly could have been because, well, one part was growing and the other part was getting squeezed. Now, Terry's right. This is maybe what's different this time around. What's our dollar like now, Terry? What has it been like?
So, I think today I checked it was about 77 US cents.
Yep.
And people were getting really excited about it because they love a higher Aussie dollar.
Because everything's cheaper.
Yep. But it wasn't like that just a year ago. 12 months ago, if you remember, the Australian dollar was on this prolonged, kind of depreciation. And look, I don't think it's particularly notable. I think it's just kind of correcting to where it usually used to sit, in between that maybe 60, 80 cent range. Yep. So it was really just heading back down where it belonged. So it went from about 80 cents to a low of 57.5 cents right when the pandemic just started to kick off. Yep. And people were really, just feeling the squeeze, pulling their money out of Australia, keeping it, wherever they keep it. And then I believe right around Q3, Q4 last year.
Yep.
Right, we started to see a little bit of a recovery to the point where we're now at 77 cents.
And a lot of that, I think, the recent recovery post-COVID has been purely a result of Australia's economic recovery versus the world.
Yeah.
The fact that we've, touch wood, been handling COVID fairly well, and that means that Australia is once again considered a little more attractive from an investment opportunity point of view. So, Terry, what on earth has been the difference then, right, that's caused our dollar, despite all of this, incredible demand for our commodities and high pricing, to stay low and to depreciate?
Well, I think as you guys probably know, when you have looked at exchange rates, there's so many things, there's so many little moving parts. It's often quite hard to pinpoint a particular reason. But one reason I can give you, Rowan, is just this time around the interest rate game's a little bit different. So if you guys remember from your course theory that the interest rate differential was quite important in determining the relative demand for the Australian currency versus other currencies. Long story short, the higher the interest rates or the cash rate in a particular country, the more demand there will tend to be for that currency. So they typically kind of move in the same direction.
That's right.
That's how I remember.
Higher interest rate or cash rate, higher value of the currency. Yeah. Typically.
But this time around, as you guys know, our cash rate has been at 0.1% since last year.
Yeah.
And it hasn't moved. And there is talk of it not moving until 2024. And so when speculators think about that, and when people who buy and sell currency consider that, they understand that this is not a currency which is going to appreciate much. And it's all factored in just keeping it quite low key. Because if you think about the US cash rate It's now back up at 2.5%.
Well, it's dropped. It peaked at 2.5.
Okay, it peaked
yeah. So I think what's interesting here is that, I mean, COVID sort of has caused everyone, right, to just go to zero, right, in terms of global monetary policy. I think what was interesting is if we look at when the dollar started depreciating, it was sort of, 2017, give or take. It sort of starts, it starts to, and then 2018 was really where we saw the beginning of the descent. And it's interesting because Australia's interest rates, right, have really since 2017, they were, I think, 1.5%
for a long
time.
That was a long time. Yeah.
And that was already historical low. And then in 2019, they start dropping and they get to 0.75% in 2019.
Yeah, if I'm like, they haven't increased it for a long time.
No, that's right. And now it's 0.25, right? Or
0.1.
0.1, sorry, of course, right? It's even lower, right? Now, what's interesting is at the same time, the US, though, was going through an economic recovery. They had interest rates that were on the floor basically since GFC for 7 years, right? They just basically didn't touch them. They were practically zero. And as they start in 2016 going through this recovery, what they start doing is they start increasing their interest rates. So sure enough, by 2018, we've now got a negative interest rate differential, right? The US interest rates are now higher, and they eventually, as Terry highlighted, they peak at 2.5 before collapsing again. And as a result of their peaking, there is a positive differential for the US and negative differential for us.
And therefore more demand for US dollars versus the Australian dollar.
That's right.
And as you know, exchange rates are just basically currencies being swapped. So if people prefer one over the other, one goes up, the other has to go down.
And so what's sort of awesome here, and this is, I sort of geek out on this, right, is the fact that, we have this outcome which is just like best of both worlds. Because usually high terms of trade and high international, like good international competitiveness, don't really coexist, right? Because if the terms of trade is high, it's usually driven by commodities, and therefore that causes the dollar to go up and it erodes our international competitiveness for our services. Right now, we've got this absolute best where we've got amazing terms of trade, we've got pretty solid international competitiveness, and therefore it means that all of our exports, not just our resources, but the little services we can export right now, are actually pumping and doing really well, which is amazing and super rare. Yeah. I think the flip side is, are we buying as much imports as well?
So during COVID, I saw that imports had fallen basically by the same amount that exports did. I haven't seen any updated data, but I would imagine they probably recovered possibly at a slower rate.
Yeah. And that's just, again, because of like the elasticity, there's time delays. And so the good thing here is that what it means is because our export volumes have grown so much, imports have stayed sort of fairly consistent, as Terry's highlighted. The net result overall has been, a much larger trade balance that's therefore pushed our current account from a deficit into a surplus. Now, I guess a question, Terry, what are some of the implications of this current account surplus? Are there any, and will this continue to happen in the future?
So I think first thing to mention is that we need to understand what's good about a current account surplus. And if you remember in your definitions, you're talking about current income that's coming in, flowing into Australia from other countries. We're earning money for, the first times in 50 years, as Rowan said at the start. Like, we're earning money from this. Like, we're doing okay.
Great outcome.
The other thing I just wanted to mention was that international competitiveness, from what I've seen, and experts tend to say this, is it needs to stay, the dollar needs to stay around less than 80 cents. Yeah. And so since we are, as I said this morning, we're about 77 cents. We're kind of reaching that kind of upper echelon. So if I was to take a stab, I don't think it's really going to sustain. I think we are, as Ron was saying, it was a perfect storm, a perfect scenario, COVID craziness. You know what, I'm going to start calling it that, just COVID craziness. But I don't really see this, particularly staying for a long time. I think that the structural issues remain. We do still, as you see, our export base has got narrow again. We still continue to have a saving investment gap. And so I don't think it's going to stay around. Yeah. But I think let's just enjoy it while we can.
That's true. I think some thoughts on whether or not it stays. I think for the length of time, I expect we may still see another current account surplus in 21, possibly and even a very small sliver of a surplus in 22, right? Okay. Possibly, and I think that depends though on two things, right? I think one, it depends on Brazil's ongoing supply issues. It depends on China's ability to get Indonesia to turn on more iron ore, and if they shift some of their demand for iron ore away from Australia, that'll impact to some extent, maybe not the prices, but certainly our export volume. If of course Brazil gets their sort of stuff together much quicker, the supply constraint that's driven prices will sort itself out. But none of those tailing dams like solution, they're not quick fixes, right? So there's going to be some length of time that it takes where I think supply remains constrained. I think the other thing for me, so I think that plays out a little bit, and I think I could see that for this year, 2022 potentially as well, potentially. I think the other thought is the interest rate differential. You're right, if our dollar starts continuing to creep upwards, that's going to erode some of our international competitiveness.
And that's without our cash rate at 0.1.
That's right, which is crazy. I think a lot of that depends on, to be honest, how the US economy recovers. And let's be honest, right now, it's not looking super crash hot. I mean, certainly better than maybe 6 months ago, but it's still very questionable in how the US economy is going to go. They've been doing a lot of vaccine rollouts.
Better than us.
Yeah, better than Australia. They've got something right. But there's still a lot of issues in the US economy, and so certainly if the US economy starts to do better, I mean, there are a lot of emerging concerns in the US. I mean, Australia as well around risks of hyperinflation and how that gets handled. So there is a question of what will happen with the interest rates.
Yeah, and I think ultimately the central banks are considering other macroeconomic indicators rather than the current account balances at this point.
That's right.
They're more concerned about things like unemployment, inflation, economic growth. So if those start to show a bit of weakness, and then they need to go in and do what they need to do with the cash rate, I really don't.
That's right.
See this.
I think the only people that are caring about our balance of payments is probably the Liberal government in their desire to get back to surplus as quick as possible.
Yeah, any surplus counts, yeah.
But I'd certainly agree. I think structural problems, all of this does is just simply paper over the underlying structural problems that we have, which is the saving investment gap that Australia struggles with and has struggled with for many years. I think the short-term benefit we get is certainly that we slow the debt accumulation cycle that we've been in by having, a current account surplus means that we have a deficit on our capital and financial account, right? We have money actually flowing overseas where we're investing or lending to foreigners in greater levels than we're receiving here. And what that does is it has a positive impact for the short period of time that it does on the size of our net foreign liabilities, which in turn hopefully then has a positive flow-on effect for our net primary income over the next couple of years. And so it gives us an opportunity to slightly, in a very small way, improve our structural problem. It doesn't structurally change it, but it manages to reduce it a tiny bit.
And I think it actually has been improving in some regards. So since 2013, the net foreign equities has actually been negative, which means that in terms of the equity investment, right, we actually have been investing more in other countries versus them investing in us. But that's been there since 2013, right?
Right.
So it's not like it's something totally new.
So there you have it, guys. Hopefully what you've now got is a much clearer understanding of what's driving our current account surplus, whether or not it's a good thing or a bad thing, and hopefully you'll see that there are some real positive implications. And also, I think a sense of how hopefully exchange rates in terms of trade, international competitiveness, all sort of come together to really drive outcomes on our balance of payments. If you have any questions, I know it's a complex topic. It's one of the harder topics.
I think most people hate this topic the most.
I don't know. I love it.
I like it. I like it too.
If you have questions, though, let us know in the comments below. If we can support you, fantastic, we will. If you need more support, you've done this and you still don't get it, you've watched this video and you're still needing some help, both Terry and I lead classes here at Art of Smart for Economics. We have an incredible team as well of one-to-one economics tutors that can just come in, dive in and clarify balance of payments or exchange rates or whatever it might be to get you ready for your HSC exams. So don't be shy, get in touch with us at artofsmart.com.au. Otherwise, all the best with HSC Economics, and we'll see you in another episode.